More flexibility, higher returns. In this episode, I'm going to address the question, what is the difference between whole life insurance and max funded IUL? How do they compare? You're going to be blown away with what you learn. So my name's Doug Andrew, and I have studied in-depth life insurance for more than 45 years. And so let me give you a little history behind whole life and universal life. Actually, every insurance policy has a term insurance component. So you've probably heard of term insurance and permanent insurance, or what is typically called whole life insurance. For years, see, term insurance is simply a policy where you pay your cost or risk of dying in a given year. So the premium may go up every year, or you may pay a 10-year level premium and the insurance company is charging you the average cost for that risk. That's term insurance. But see, whole life came out when people said, you know what, instead of having to pay a higher premium every year that I get older, I would like to pay a level premium. So I'm willing to way overpay the early years that I own this whole life policy because it's going to cover me for my whole life. So I way overpay the actual cost of the insurance or the risk during the early years, and I build up excess equity or cash value in that policy because I'm way overpaying in the early years. That means later at age 60, 65, I'm actually underpaying, but all the cash value that has accumulated in there where the insurance company is paying me interest is now covering the higher cost of insurance, because insurance is based upon the cost per thousand of coverage, and it gets higher as you get older. Well, not if the amount of insurance that is at risk goes down. So as you build up cash inside of an insurance contract, that can qualify as part of the death benefit. It can also be added on top of the death benefit. But see, there was traditionally just term and whole life, and frankly, from 1974, when I first started as a financial strategist, until 1980, I was a huge proponent of buy term insurance and invest the difference instead of whole life, because mathematically I could prove that the traditional whole life insurance policy only credited you maybe 3.5%, 4.5%. There may be some companies out there that would tout 6, 7, 8% dividend rates. But let me tell you a little secret here that many of their agents didn't even understand. But before I go any further, let me say, hey, whole life insurance isn't bad. I mean, it's very good for death benefit purposes. There are many times people need a guaranteed death benefit to be able to pay off debt or some obligation or to provide for somebody, and they want to make sure that that death benefit will be there regardless. And so there are certain guarantees afforded in most whole life insurance policies if that is your primary goal. Now, when I talk about max funded IUL, I'm talking about usually a primary goal being capital accumulation, to accumulate my money tax-free and be able to generate tax-free income. If that's your primary goal and the death benefit is secondary, I can show you how indexed universal life has far more flexibility and the ability to generate more tax-free income by far for as long as you live than a whole life insurance policy, and I'm going to explain why. So universal life was the brainchild of E.F. Hutton clear back in 1980, and their purpose was to maximum fund it and use it for living benefits, not for just a death benefit. In other words, where people could put in $500,000 and let it grow and double to $1 million, and that $1 million doubles to $2 million, and when they had $2 million of cash value, to be able to generate $200,000 a year of tax-free income. If that's your objective, whole life insurance does not have near the flexibility. For example, When you take out a whole life insurance policy, you're sort of on the hook, obligated to pay a certain premium for a certain number of years. Not on all policies, but see, there's not as much flexibility. Universal life, you can put in more money, you can skip years, you can skip payments. If I want to accommodate $500,000 over a 5-year period, and I put in $100,000 the first year, I could skip the next 4, 5, 10 years and not put in a dime, and then start picking up and putting in money into the universal life policy. I can put in the other $400,000 in one fell swoop. You don't have that kind of flexibility with whole life insurance. You're obligated for a certain amount. But I used to train insurance agents. In fact, I had over 3,000 come through my intensive 3-day training. And I had some of the top whole life insurance agents in America come through my training. And they were blown away. One had a very reputable company that touted 8% dividends. I said, what is the internal rate of return on your whole life policy? He goes, 8%. I said, no, it isn't. I'm talking about internal rate of return. He goes, well, I've never been taught that term. I wonder why. The internal rate of return is this. You calculate based on the money you paid in premiums. At the end of the day, if this is the cash value they say you have, you put that cash value into the calculation, the amount of premiums you paid at the frequency you paid them, and you calculate what interest rate would you have to be earning to end up with this much money. It wasn't 8%, it was 5.9%, and it took until age 70 before it did that. It was till age 95 before the internal rate of return was within 1% of the gross rate of return of 8. In other words, he was earning 8, but only netting 7, but it took until age 95 to achieve that. At age 65, when most people retired, the internal rate of return was 2% less. It was 5.9% instead of 8. That's whole life insurance. He had no clue how to compute internal rate of return because whoever trained him didn't want him to know that that was an important calculation. With the same money in an indexed universal life insurance contract, if I put that in, I have averaged 10% and netted 9. I can earn 11 and net 10. I can earn 10, I can net 9. I can earn 9 and net 8. The whole life policy, earning 8, which most now don't earn, only netted 6. So I can earn a higher rate of return with more flexibility as I'm funding it. I can get the money in faster under the TAMRA law. I can fill up to the maximum level on a universal life the policy in 5 years. Whole life takes 7 years. It's called the 7-pay test. So I can get the money in faster. If I want to get in $1 million, I can get it in 200 grand a year for 5 years. I have to wait 7 years to fund a whole life policy, and it will generally earn a lower interest rate, and it will not generate the same internal rate of return. So the point is this: I have more flexibility with universal life. I usually earn much higher rates of return by 2 or 3 percentage points. If I earn 11, I net 10, which is what I've been doing for the last 25 years, while most whole life policies have only been earning 8 at best to net 6. Hello? And so I like the flexibility. I like to be able to fund it faster. It will grow to more money. I have more options. I can participate when the market goes up and not lose when it goes down, on and on and on. So other than that, I don't have any strong feelings on this subject. So what's the takeaway on this? If you want to see the real difference, ask a whole life insurance agent to generate a predictable income stream based upon the amount of premiums paid into the policy over a time period, and then take out tax-free income to age 120. And then have somebody who understands how to structure a max-funded IUL, do the same amount of money, the rate of return based on historical averages, and show how much income could come out. And I assure you, it will knock the socks off of the whole life policy as far as predictable income. One last feature that I love about IUL compared to whole life is if you are into the banking concept, be your own banker, bank on yourself. They usually promote whole life. Now, that's good, but what they usually show you is borrowing money out of your whole life policy to run your business or to buy a car or whatever. Yeah, you're borrowing your money. Why would you do that? Because you keep earning interest But hello, if you borrow money out of the whole life policy and they charge an interest rate and they only credit you maybe 1 or 2% higher, that is not going to be as good as a max funded IUL. For example, our clients, business owners, or retirees who use indexed universal life, they take it out the smart way because it's tax-free. So if they borrow it out, they are charged 4.6%. Now, if you just want zero wash loans, you can borrow it out at 2 or 2.5%, and the insurance company will credit you 2.5% on the collateral that is in the policy that is held there to give you the loan. Because if you take it out the wrong way, you may subject yourself to taxes that are unnecessary after you've recovered your basis. That's the stupid way to pull it out. If you use loans, do you ever have to pay them back? No, they're not due and payable during your lifetime. They're washed away with the death benefit. Why would you borrow your money? Because if you choose, they'll charge you, let's say 2.5% and credit you 2.5%. It costs you a net of zero, but it makes your income tax-free. But what I do, and what most of the clients do that are trained with index loans, is they borrow out, let's say at 5%. I had a business owner that borrowed $1 million out of his policy in 2017. He said, I want to do the index loan, charge me 5%. What's 5% on $1 million? 50 grand. He doesn't have to write out a check for 50,000. It's deducted from the interest he kept earning on his million because he didn't withdraw it. He left the million there. He borrowed $1 million with his million as collateral. What did that million earn that year on his index policy? 25%. What's 25% of $1 million? 250 grand. He made 250,000 of interest on his cash value on the million while he was using $1 million loan out of that policy at 5%. So 250,000 minus 50,000, he netted $200,000, 20% tax-free rate of return net on his million while he was using his million for his business. You cannot do that with a whole life policy. So if this is intriguing you and you want to learn the answer to this question and many more, subscribe to this YouTube channel, but also I would encourage you to get a copy of my most recent best-selling book, The Laser Fund. It is 300 pages of charts, graphs, and explanations, and 62 actual client stories. I will buy the book, okay? I want to gift this to you free. You just go to laserfund.com, pay $5.95 shipping and handling, and I will fire out a copy of this to you absolutely free. You can learn why this is the superior vehicle of my choice for serious cash in retirement. If it were me, I would have 40 to 60% of my retirement income coming at an 8 to 10% payout, totally tax-free. Wouldn't you?